Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Intercontinental Exchange's stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. The Intercontinental Exchange was formed in 2000 and operates global exchanges, clearing houses, and provides mortgage technology, data, and listing services. The company owns exchanges for financial and commodity markets and operates 12 regulated exchanges and marketplaces. Let's get started with the model. This is a large cap company, 66 billion market cap. They're trading at $118 a share, and they have 561 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and growing free cash flow from 1.7 billion to 2.3 billion. Net income is the profit and loss on the income statement, and that's pretty steady, $2 to $2.5 billion a year. Revenue is the sales for the company, and that seems to be growing each year from 5.8 billion to 7.4 billion. They also have really good profit margins, 29% up to 43%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. So they converted 29% of their revenue into profit in the trailing 12 months. That means 71% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Then the difference is the gross profit, and that was the highest in the trailing 12 months at 4.5 billion. Then you have operating expenses. Gross profit minus operating expenses is your operating income, and that was almost $3 billion. The company does have a bit of debt, so they have interest payments on their debt, then other income and expenses, and of course taxes. And the bottom line of the income statement is their net income, and that was 2.2 billion in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. That was 2.7 billion. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow, and that was 2.3 billion in the trailing 12 months. Pretty similar to 2019 and 2018. But a nice jump from 2017. The company does pay a small dividend, but another way to reward investors is to buy back stock. Because if the company buys back stock, that lessens the shares in the market, making your shares more valuable. And they bought back 1 billion in 2017, then 1.3 billion, 1.5 billion, then 1.9 billion. In 2017, they issued 1 billion of debt, but paid down 1.3 billion of debt, so they reduced their total debt $300 million. But in 2018, they increased their debt about 1.4 billion, and in the trailing 12 months, they increased their debt about 1.2 billion. The most important part of any business is their operating cash flow. In order to have a successful business, you need to generate a positive and healthy operating cash flow. $2 to $2.7 billion each year. And to calculate operating cash flow, you take net income, that was $2.2 billion, and then you have to add back the non-cash items that were passed through as expenses on the income statement. They had $661 million of depreciation. You also have to adjust for changes in working capital. That was negative $313 million. So even though they had $2.2 billion of net income, they generated $2.7 billion of cash. When you look at the income statement, you have to remember that's not cash. Net income is your accounting profit and loss. Your actual cash is on your cash flow statement. Let's look at a capital structure. They have 17 billion of equity, $8 billion of debt. They're 68% equity, 32% debt. I like to invest in companies with less than 50% debt. Their WACC is 7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 75 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $67 billion. We divide that by 561 million shares. and we get a calculated stock price of 119. They're trading at 118, so they're trading at pretty much what I'm calculating. Simply Wall Street's valuation is $92, so they're saying the company's overvalued. They're saying it's a sell. So it looks like the stock has only gone up the past 5 years, so wherever you bought it, you would have made a nice return. And the company's increasing their dividend pretty aggressively each year, 17 cents up to 30 cents. That's an increase of about 70 or 80%. And their dividend yield is 1%. To calculate dividend yield, it's annual dividend payment over market cap. Or you can just sum up the last 4 dividends and then divide by the stock price. They have a 31% payout ratio. That's annual dividend over net income. And they pay out 29% of their free cash flow. That's annual dividend over free cash flow. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $56,500 today. If you did not reinvest the dividends, you would have $54,000 today. If you invested $10,000 in this company 10 years ago, you would have been better off never selling the stock because it just kept going up. So if you sold it here, you would have been upset because it kept going higher and higher. This stock has a pretty low beta, 0.68, so the stock moves less than the market. The price has increased 24% in the past 52 weeks, better than the S&P 500 of 16%. The low was 63.51, the high was 118. The stock is trading above its 50-day and 200-day moving average, so it's on an uptrend. And when the 50-day moving average crosses above the 200-day moving average, that's called the golden cross. That's a bullish signal. About 2 to 2.5 million shares are traded each day on this stock, and most of the shares outstanding are on floats, so they're available for investors to purchase. Institutions are very bullish on this stock. 94% of the shares are held by them, and has a really low short percentage, 88 basis points. Vanguard is the biggest shareholder, over 7.5%, then Capital Research at 7.25%, BlackRock, State Street, then Lazard Asset Management. Let's look at their financial ratios. The average PE in the market's 11.9, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 30.7, so a bit worse than the median and average. 30.7 means investors are willing to pay $30.70 for $1 of earnings. Price to sales is stock price over sales per share. They're at 8.9. Price to book is stock price over book value per share. They're at 3.8, so they're between the median and average. Book value per share is equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $17.3 billion of equity, but negative $6.3 billion of tangible equity because they have $23.6 billion of intangible assets on their balance sheet. A company cannot produce an intangible asset. The only way a company can get an intangible asset is when they merge with another company or acquire another company. Interest coverage ratios, EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They're at 12%, a little better than the median. Current ratio is current assets over current liabilities. They can almost cover their current liabilities with their current assets. Most of their current assets are prepaid assets of $65 billion. A prepaid asset is when a company makes an advance payment for a good or service to be delivered in the future. To understand what the $65 billion represents, you need to look at the company's 10K. It seems like the company is somewhat well capitalized. They had $2.3 billion of free cash flow, but negative $837 million of working capital. Working capital is current assets minus current liabilities, plus they have a $700 million dividend payment they need to pay each year. The best way to look at ratios to compare them to similar companies, I've done videos on CBOE, CME, Moody's, MSCI, NASDAQ, OTC, and S&P, all in the same industry as ICE. And if ICE has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're a little worse in price to earnings and price to sales. The average price to book is 0 because one company has negative 100, so they're better than average. Current ratio, they're doing a little worse than average, but they're pretty close to 1, so that's not bad. They're doing worse than average in ROE. They're doing much better than average in debt. And they're a pretty big company, more than double the average market cap. And their dividend payment is a little lower than average at 1%. So to summarize, I have them trading at intrinsic value, But a company like this isn't going away because the only way they're going to go away if the stock market goes away. And they have really healthy and consistent free cash flow net income, and their ratios look okay as well. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.